Hello, everyone, and welcome to the Deep Dive. Today, we're taking a comprehensive look into an absolute titan of global finance, JPMorgan Chase & Co., JPM, as it's known on the markets. Now, on the surface, it stands as this colossal, seemingly unbreachable entity in the financial world. Just massive. But for us, as informed learners seeking genuine understanding, the real question becomes, how truly impenetrable is this structure? Are its strengths really as profound as they appear? Or are there nuances the casual observer might miss, things critical to understanding its long-term trajectory? That's precisely what we're here to uncover together.
And that's a fantastic mission for this deep dive, really is. Our goal here is to equip you with a, let's say, nuanced understanding of JPM's enduring quality, the stewardship behind its massive operations, and, what its true value proposition signifies within the broader financial landscape. We'll be navigating through its intricate workings to reveal the core insights, get the complete picture.
Okay, so let's begin by pulling back the curtain on this financial services behemoth. When we talk about JPM, we're talking about an entity with nearly $4 trillion in assets. How exactly does a machine of this scale generate its revenue and, maybe more importantly, its profits? What are the fundamental gears turning inside this enormous enterprise?
That's the perfect place to start, really the foundation, because understanding the underlying business model is truly foundational. JPM operates through four primary business segments. Think of them as distinct yet interconnected pillars supporting this immense structure, and each contributes significantly to its overall financial performance. The first, and perhaps the one most people recognize, is Consumer and Community Banking, CCB. This is the familiar Chase brand, right?
Yeah.
The one you likely interact with for personal banking. It serves a staggering 82 million U.S. consumers and 6.4 million small businesses. That makes it an indispensable part of daily economic life for millions.
82 million consumers. Just incredible reach.
It is. So how does this segment make its money? Primarily through two channels. First, net interest income. Think of it like this. JPM takes in deposits, essentially borrowing money from you at a lower rate. And then it lends that money out, mortgages, auto loans, credit card balances at a higher rate. That difference, that spread between what they pay and what they earn, that's the core income stream for classic banking. And JPM masters it at an immense scale.
Okay, the classic banking model, just supercharged by scale.
Exactly. The second channel is non-interest revenue. This comes from various fees, things like fees from debit and credit card transactions, payment processing, maybe account maintenance fees. And the scale here is just, it's immense. Chase isn't just large, it's dominant. It holds the number one position in U.S. retail deposit market share, and it's the number one U.S. credit card issuer. That's a huge, stable base generating consistent income from just everyday activity.
Right, that deep penetration into the consumer side is clear. Really paints a picture. But then we have the JPMorgan brand. That feels like a very different beast altogether, doesn't it? How does that consumer foundation then connect with JPM's role on the global investment banking stage?
Good question. That brings us to the Corporate and Investment Bank, or CIB. This operates under the, let's say, prestigious JPMorgan brand. And this segment is a true global powerhouse. It advises the largest corporations, institutions, governments worldwide. Here, they generate substantial fees by providing strategic advice on mergers and acquisitions, M&A advisory, and by helping companies raise capital, underwriting equity and debt offerings. They're essentially the orchestrators of major corporate finance deals.
So facilitating those huge transactions we read about.
Precisely. Their markets division also generates significant revenue through sales and trading activities across various asset classes, navigating the complexities of global financial markets. And critically, their security services division provides essential post-trade functions, like asset custody. They safeguard over $32 trillion in client assets. Think about that number.
32 trillion. It's almost hard to comprehend.
It really is. And this isn't just a large business, it's a leader. They've been ranked number one in global investment banking fees for an incredible 15 consecutive years. That demonstrates just unparalleled dominance in a fiercely competitive arena.
Okay, so from my everyday checking account to multi-billion-dollar corporate deals, they truly seem to have the full spectrum covered. But what about that vital middle ground, the businesses that are growing rapidly but aren't yet global titans? How does JPM bridge that gap?
That's exactly where the commercial banking segment, or CB, comes into play. This is a critical, though maybe less visible niche within the whole JPM ecosystem. CB focuses specifically on mid-sized businesses and sophisticated real estate investors. They offer tailored lending solutions, treasury management, payment services. supporting these growing enterprises.
So nurturing them as they grow.
Exactly. And what's particularly fascinating about commercial banking is its strategic role within JPM's broader framework. It frequently acts as a vital conduit, nurturing relationships from the ground up, effectively graduating successful commercial clients who might one day need the more complex capabilities of the CIB, or perhaps the asset and wealth management segments. It's really about cultivating those long-term client relationships across their entire growth trajectory.
Okay, that makes sense. And speaking of managing assets for institutions and individuals, that brings us to the final piece of the puzzle, doesn't it?
It does. The fourth segment is Asset and Wealth Management, or AWM. This division provides sophisticated investment and wealth management services across the globe. They earn fees for managing trillions of dollars in client assets. Their clientele is diverse, large institutional investors, ultra-high net worth individuals, but also everyday retail investors seeking professional guidance.
So managing money for basically everyone, from huge funds to individuals.
That's right. And the trust they've cultivated here is clearly reflected in the numbers. In 2023 alone, AWM saw record client asset net inflows of $490 billion.
Wow.
Nearly $500 billion entrusted to them in a single year. That really highlights the deep confidence clients place in JPM's ability to manage and grow their wealth.
It's quite something. But, despite this vast global presence and the intricate nature of these different offerings, what's genuinely striking here is that the core business feels remarkably straightforward. Almost timeless in a way. It's not built on the latest tech gadget or some fleeting consumer trend, is it?
You've hit on a truly critical point about JPM's enduring quality. Absolutely. Despite its nearly $4 trillion in assets and its global complexity, at its very essence, JPM's business model is fundamentally simple and highly intelligible. They're engaged in activities that are, quite frankly, foundational to any capitalist economy that requires sophisticated financial intermediation.
Like the basic building blocks.
Exactly. Taking deposits, the absolute bedrock of banking, making loans to individuals and businesses, directly fueling economic activity, facilitating payments, acting as the circulatory system of global commerce, advising on capital formation, helping companies grow, managing wealth for generations. These aren't services susceptible to fads or, technological obsolescence in the same way many other industries are. As long as people and businesses need a trusted intermediary to store, move, borrow, and invest capital, the essential services JPM offers will remain not just relevant, but indispensable.
Indispensable, that's a strong word.
Well, think about it. It implies that JPM's extensive diversification provides this powerful, almost all-weather characteristic. Think of it as an internal shock absorber. A natural hedge, maybe. For instance, the consumer and community banking segment, CCB, is highly sensitive to interest rates, right? When rates rise, their net interest income tends to expand. Good for them. Conversely, the corporate and investment bank's revenue is often more sensitive to market activity, M&A deal flow, capital markets volatility. So when one segment might face headwinds due to a particular economic condition, another often benefits from a different set of circumstances. It creates this natural counterbalance, ensures earnings resilience through various economic cycles. They move nearly $10 trillion in payments daily.
$10 trillion a day.
Yeah. It's truly a utility for global commerce. That immense constant flow of capital undeniably cements its indispensable role.
It sounds like this goes beyond mere diversification, though. There's a powerful interconnectedness at play, almost like a self-reinforcing engine. How do these seemingly distinct segments interact to create this integrated ecosystem?
Absolutely. They're far from independent silos. That's key. They form a deeply integrated and self-reinforcing ecosystem. And that seamless integration is arguably a primary source of JPM's competitive strength. We can think of it as a powerful flywheel effect. It allows for comprehensive client lifecycle capture, something most monoline competitors, firms that only do one thing, they just can't replicate it.
Can you give an example of that flywheel?
Sure. Let's imagine a classic client journey. A small business owner might start with JPM through a simple Chase business checking account, that's CCB. As that business flourishes and expands, it'll need more sophisticated financial services, right? Maybe a larger line of credit, more robust cash management, treasury services. That's when they naturally graduate to the commercial bank, CB.
Okay, moving up the ladder.
Exactly. Now, as the business owner's personal wealth accumulates from their successful enterprise, it creates a natural, highly synergistic opportunity for the Asset and Wealth Management Division, AWM, to step in and manage those growing assets. And should that company continue its impressive growth, maybe needing to go public, raise significant debt, or make a major strategic acquisition, then the Corporate and Investment Bank, CIB, steps in to facilitate those complex, high-value deals.
So one relationship potentially feeds multiple parts of the bank over time.
Precisely. The result is profound customer stickiness. It means JPM isn't just capturing one revenue stream from a client. They're generating multiple, often high-margin revenue streams from a single, evolving relationship. This creates a powerful virtuous cycle. Each interaction strengthens the bond, organically opens doors for further business, making it incredibly difficult for a competitor offering only one piece of the puzzle to break in and dislodge them.
That powerful customer stickiness. That sounds like a cornerstone of JPM's competitive advantage. What truly protects this enterprise from its formidable competitors, what forms its fortress, as they say, and allows it to sustain its long-term earning power.
Right, the economic moat. JPM's moat is indeed formidable, and it's built not on a single advantage, but on a powerful combination of several key factors that reinforce each other. We can identify, I'd say, three primary sources that create this defensive fortress. First, scale-based cost advantages. JPM's sheer size is just unmatched across the full spectrum of financial services, nearly $4 trillion in assets. This immense scale allows the firm to spread its enormous fixed costs over the industry's largest revenue base. Think about their annual tech budget, $17 billion.
$17 billion on tech alone.
Yeah, more than many entire companies spend on everything. Then there are the immense regulatory compliance expenses, which can be crippling for smaller institutions. By spreading these colossal, largely fixed costs across such a vast operational base, JPM gains incredible operational leverage. What's the tangible outcome? Well, they can invest significantly more than rivals in cutting-edge tech, attract top-tier talent. They can offer more competitive pricing because their per-unit costs are lower, and still manage to generate superior returns. It's a classic example of how being the biggest can make you the most efficient. Low-cost producer advantage.
Okay, scale is definitely one pillar. What's the second?
Second, and perhaps most critical in finance, are intangible assets, particularly brand and trust. In finance, trust is really the ultimate currency, isn't it? The JPMorgan and Chase brands are globally recognized symbols of financial strength, stability, reliability. CEO Jamie Dimon famously coined fortress balance sheet. It's far more than just a catchphrase. It's deliberate, powerful branding, synonymous with the firm's identity. This deeply ingrained reputation for prudence and stability creates a powerful flight to quality phenomenon during stress. When uncertainty hits, capital and clients instinctively gravitate towards JPM. They see it as the safest harbor in a storm. We saw it in 2008, saw it again more recently. This intangible asset provides an immense, almost self-fulfilling advantage in crises.
Right, that trust factor is huge. And the third layer of protection for this fortress, how do they keep customers from leaving, especially the big ones?
That brings us to high switching costs. While it might be relatively easy for, say, a retail customer to close one checking account and open another, though Chase tries hard to keep them, the switching costs for JPM's larger, most valuable institutional and corporate clients are prohibitively high. Just imagine a multinational corporation relying on JPM for its global payment infrastructure, its complex treasury services, or for safeguarding its massive asset holdings through securities services.
Yeah, unwinding that sounds like a nightmare.
Exactly. Or consider a high net worth family with intricate multi-generational trusts managed by the private bank. Disentangling from these deeply embedded services, it would involve an incredibly complex, costly, and operationally risky overhaul of their entire financial infrastructure. JPM services are just woven so deeply into the fabric of these clients' operations. It creates a powerful barrier to them moving elsewhere.
That fortress characteristic, it isn't just theoretical, is it? It was dramatically tested in the real world during the 2023 U.S. regional banking crisis. How did JPM's strengths actually manifest in that high-stakes environment?
Oh, absolutely. That crisis provided a vivid, real-time demonstration of JPM's moat in action. As confidence in several regional banks just evaporated rapidly, there was a massive flight to safety. Depositors immediately moved their capital to larger, perceived, safer institutions. JPMorgan Chase was one of the primary beneficiaries of these inflows. That spoke volumes about its perceived stability and trustworthiness.
So they benefited directly from the turmoil.
They did. But even more importantly, JPM's unparalleled financial strength and credibility allowed it to step in. They acquired the assets of the failed First Republic Bank. Now, this wasn't merely an opportunistic expansion. It was a move that actually helped stabilize the broader U.S. banking system during a critical period. And for JPM, it immediately added over 500,000 new affluent customers to its ecosystem. And it was immediately accretive to earnings, added to profits right away. It was really a textbook case of a company whose underlying strength and moat are so robust that it can turn a systemic crisis into a strategic, value-enhancing opportunity.
Okay, so given this demonstrated strength, is this moat just stable, like a fixed advantage that just stays the same? Or is it actively getting stronger, widening over time, and further separating JPM from its competitors?
That's a really important question, and the evidence points strongly to the moat actively widening. JPM isn't resting on its laurels, not at all. It's making strategic decisions, continuous investments that deepen its existing advantages, and that creates an ever larger capabilities gap between itself and its rivals.
How so? What are they doing specifically?
Well, first, the firm's colossal and ongoing investments in technology, data analytics, and AI. These are creating a capabilities gap that smaller rivals just find impossible to bridge. These billions aren't just about internal efficiency, they dramatically enhance the customer experience. They improve risk management across all segments. And crucially, they lower the marginal cost to serve each client, which directly widens that scale-based cost advantage we discussed. They're building a future others struggle to keep pace with.
So tech is a big part of it. What else?
Second, the increasingly complex and costly post-crisis regulatory landscape. Now, this is undoubtedly a burden for all banks, but ironically, it functions as a powerful barrier to entry for new players, and it's a persistent competitive disadvantage for smaller, less resourced institutions. JPM's immense scale allows it to absorb these significant compliance costs far more efficiently than its smaller peers, effectively transforming what might seem like an industry headwind into a relative competitive advantage for the biggest players.
Interesting, turning regulation into an advantage almost.
In a relative sense, yes. And finally, in a truly contrarian move, while many competitors are shrinking their physical footprint, JPM is executing a strategic expansion of its branch network into new states. They plan to open 500 new branches by 2027.
Really? Adding branches now?
Yeah, it seems counterintuitive, but the strategy is about deepening their access to low-cost core deposits. That's the essential raw material for banking, and simultaneously strengthening its brand recognition at a local level, solidifying market position, bringing in new customers, and this widening trajectory. It's also accelerated by a powerful feedback loop, a virtuous cycle, between its scale and the unparalleled data it generates. Those 82 million consumer customers produce an unparalleled volume of transactional data every single day. This data fuels their sophisticated AI models, which in turn allow for incredibly precise credit underwriting, superior fraud detection, hyper-personalized offerings. The result: superior customer experience, better risk-adjusted returns, which attract more customers, which generates more data. It's a continuously self-reinforcing competitive edge that smaller players simply cannot replicate.
That's fascinating. So when we look at this through the lens of legendary investors like Charlie Munger or Warren Buffett, what mental models would they apply to understand a business like JPM? How would they synthesize these insights?
That's an excellent way to consolidate these observations. JPM's business and its formidable competitive position truly exemplify several core mental models favored by great investors. First, let's consider the Lollapalooza effect, a concept popularized by Charlie Munger. JPM is a quintessential example. Multiple factors combine and reinforce one another to produce this non-linear, overwhelmingly powerful outcome. It's not just having many advantages, it's how they interlock and amplify each other.
Like gears meshing together.
Exactly, like a complex gear system where each gear makes the next spin even faster, creating momentum that's almost impossible to stop or replicate. It's the confluence of immense scale, deep brand trust, tech superiority, regulatory barriers favoring incumbents, and that powerful diversification. All these advantages amplify each other, creating a competitive fortress far stronger than the mere sum of its parts. Its dominance isn't from one thing, but the interplay of all of them.
Okay, the Lollapalooza effect. What else?
Then there's the circle of competence, famously championed by both Buffett and Munger. From an investor standpoint, the fundamental business of banking, even at JPM's vast scale, is remarkably intelligible. It falls squarely within a traditional circle of competence. The core drivers, net interest margins, fee generation, credit quality, operational leverage, are understandable concepts. They've endured for centuries. This isn't a business whose success hinges on some unproven tech or speculative new market. It operates on principles that are well understood, tested by time. Makes it easier for a seasoned investor to evaluate and predict.
Understandable, even if complex at the edges.
Right. And finally, JPM perfectly illustrates the power of scale advantages, another key Munger concept. In a business like banking, where many core products are, at heart, commodity-like, a loan is a loan. A checking account is a checking account. Being the low-cost producer is the decisive and durable advantage. JPM's massive scale provides the operational efficiency needed to achieve this, allowing it to consistently outcompete and out-earn rivals. They can just do more with less, which translates directly into superior returns for shareholders.
Okay, those models really help frame the strategic advantages. But beyond the numbers and strategies, it's always insightful to get a feel for the human element, isn't it? What's the scuttlebutt? What do people actually experience when they interact with this financial giant, both as customers and as employees?
Ah, yes, the qualitative layer, crucial. And it reveals a more nuanced, almost bifurcated picture. Let's unpack that. Let's start with customer sentiment, specifically regarding JPM's digital offerings. Their digital platforms are widely praised, clearly indicating those mapped tech investments are paying off. The Chase mobile app, for instance, consistently gets stellar ratings, 4.8 out of 5 stars, often. Their wealth management digital experience, ranked number 1 by J.D. Power. Customers unequivocally value the convenience, the robust features, the user-friendly interface. This is where tech investments translate directly into a tangible competitive advantage and, importantly, high customer satisfaction.
So digitally, they're hitting the mark.
Seems so. However, there's a distinct flip side. We see quite a bit of customer frustration, particularly concerning human-led service channels. If you look at reviews on platforms like the Better Business Bureau, Consumer Affairs, they're replete with complaints. People report bureaucratic delays, significant difficulties resolving complex fraud issues, and often feeling like they're just a number lost in a giant system when they need personalized attention.
So the human touch is maybe lacking sometimes.
That seems to be the sentiment from a vocal segment. While JPM boasts an impressive primary bank customer retention rate over 95%, this recurring negative sentiment about personal service does represent a potential vulnerability. It suggests that while people might not leave due to the sheer hassle of switching, their experience with human interaction isn't always stellar, and it could make them susceptible to competitors who maybe excel in that specific area.
Interesting dynamic. And what about the people inside the organization, the employees delivering these services every day? What's their perspective?
The employee perspective is similarly, well, a mixed bag, to be honest, and it's critical for long-term health. On the positive side, many employees highlight a culture of excellence, a genuine commitment to diversity, ample opportunities for career growth within such a vast organization, the sheer prestige of the JPMorgan brand on a resume, the immense resources available. Those are often seen as unparalleled advantages for career development.
But there's a but, isn't there?
There is. In formal forums, internal surveys, they frequently cite a culture of intense pressure, micromanagement, and a perceived erosion of work-life balance, particularly following recent strict return-to-office mandates. Some former employees describe the environment in quite harsh terms. Overwhelming workloads, a discernible disconnect between stated values and the lived experience on the ground, especially for junior and mid-level staff. This indicates a very real challenge in maintaining morale, retaining top talent over the long term. And ultimately, this can absolutely impact the quality of customer service if employees are burnt out or disengaged.
So there's this fascinating, almost paradoxical tension here between JPM's technological prowess and the quality of its human interaction. What's the strategic implication of this dichotomy for the long-term durability of JPM's economic moat?
This is a truly crucial strategic issue, one that will define JPM's ability to maintain its leadership, I think. JPM has clearly engineered a world-class, highly scalable digital platform, immense success there. But the challenge now, and it's an entirely different, arguably more complex one, is ensuring consistent, high-quality, empathetic service. Across a global workforce of over 300,000 employees, that's a monumental management task.
And the risk if they don't get it right.
The inherent risk is clear. If more agile competitors, maybe smaller fintechs, maybe even other large banks, can consistently offer a superior human service layer, on top of what might be just good enough technology, they could begin to erode JPM's franchise. This is especially true among affluent and high net worth clients. They frequently demand and highly value personalized attention, concierge-level service. So the long-term durability of JPM's moat truly depends not only on its tech walls and scale, but also on the consistent quality of service provided by its vast network of people. It's a delicate balance they'll need to master continuously. Avoid becoming a victim of their own scale on the human front.
That makes perfect sense. A really important point. Now, let's place JPM within its competitive sphere. What are the other giants in the room? How does JPM stack up against its closest peers in the financial industry?
Right. Understanding the landscape is key. While JPM is dominant, it's certainly not alone at the top. It operates alongside other major, highly diversified financial institutions, each with its own strategic focus, its own core strengths. Let's look at a few key players. You have Bank of America, BAC, arguably JPM's closest peer, especially in U.S. consumer scale. BAC's strategy is heavily centered on responsible growth. Deep focus on integrating consumer banking, their powerful wealth management arm, Merrill, and corporate banking lines. Capturing more of each client's wallet, they emphasize that integrated experience.
Okay, both a strong integrated player. Who else?
Then there's Wells Fargo, WFC. Following a period of significant reputational challenges, Wells Fargo's strategy now is focused primarily on intensive risk remediation, operational simplification, rebuilding trust. Their emphasis is strengthening their core U.S. consumer and commercial banking franchises, where they historically held a very strong position, especially in U.S. middle market commercial banking.
So Wells is more focused on rebuilding and core strengths.
That seems fair. And finally, Citigroup C. Citi is undergoing a major strategic simplification, exiting most international consumer banking to double down on its unique institutional strengths. These include its premier global network for institutional clients, particularly its Treasury and Trade Solutions division, renowned for global payments and cash management, and its growing wealth management business.
So each of these giants has its specific strengths. But when you compare them head to head, what is JPM's singular, most durable advantage over this competitive set? What truly sets them apart?
What's truly fascinating here, and what gives JPM its unique, durable advantage, is its leadership across the full spectrum of financial services. While Bank of America is a formidable consumer competitor and Citi has a world-class institutional network, neither can consistently match JPM's number 1 or number 2 market position in virtually every single business line in which it competes. They're truly the undisputed champions across the board.
Diversification of excellence, is that the idea?
That's a perfect way to put it. Diversification of excellence is key. It creates an incredibly resilient all-weather earnings stream for JPM, ensuring that even if one sector faces challenges, others can pick up the slack. A powerful internal shock absorber. And perhaps most powerfully, this comprehensive dominance provides unparalleled cross-selling opportunities. They have the deep capability to capture an entire client's financial lifecycle, from individual banking to the most complex corporate finance needs. No single competitor can fully replicate that breadth and depth across the board. It truly sets them apart, makes them exceptionally difficult to dislodge from their premier position.
Okay, the business is strong, the moat is wide. But even a truly great business with a wide moat can still be mismanaged, can't it? So what about the leadership at JPM? Is it in good hands? Is this ship being steered effectively?
That's always a critical question, because poor stewardship can absolutely compromise even the strongest moat. In JPM's case, the answer appears to be a resounding yes. The leadership seems exceptionally strong, uniquely qualified. The most prominent figure, of course, is Jamie Dimon, CEO since 2005, his almost 2-decade tenure. Marked by a clear, consistent, widely respected operating philosophy, it's guided the firm through multiple crises, intense change. His annual shareholder letters are practically required reading in finance, often seen as blueprints for long-term thinking.
What are the core tenets of his philosophy?
Well, first and foremost, what he famously calls the fortress balance sheet. This isn't just a slogan, it's the absolute bedrock. He consistently emphasizes maintaining capital and liquidity far in excess of regulatory minimums. This deeply conservative posture is designed to ensure the firm can not only survive any conceivable crisis, even a black swan event, but also continue supporting clients when competitors are forced to retreat. This principle was dramatically validated in 2008 and again in 2023.
Makes sense. Build reserves for the inevitable storm.
Exactly. Second, Dimon is a vocal proponent of continuous long-term investment. He's famously not afraid to spend on the future, even if it means a temporary hit to quarterly earnings. His 2023 letter, for instance, details extensive multi-billion-dollar investments in AI, cloud infrastructure, new branch expansion, all framed as absolutely essential for long-term competitiveness and leadership. He inherently understands you invest today for tomorrow's advantages. And third, he articulates a pragmatic view that stakeholder value drives shareholder value. He believes long-term shareholder value is a direct result of serving all stakeholders well, customers, employees, communities. Not ideology, but a practical recognition that a business can't thrive in a vacuum or at the expense of its ecosystem. This comprehensive philosophy, consistently applied for nearly 2 decades, it's the hallmark of disciplined, long-term, owner-oriented thinking.
That strong philosophy sounds incredibly reassuring on paper. But how are management's incentives structured? Do they truly have skin in the game, aligning their personal wealth with the long-term performance of the company?
They absolutely do. The executive compensation structure is meticulously designed to align management's interests directly with long-term shareholders. Real skin in the game. A significant portion of variable comp comes as performance share units, PSUs. These typically vest over 3 years, contingent on the firm's return on tangible common equity ROTCE performance, both absolute and relative to peers, directly linking pay to a crucial metric of shareholder value creation and capital efficiency.
So performance matters directly for their paychecks.
Very directly. Furthermore, JPM enforces stringent stock ownership and retention requirements. Jamie Dimon himself must own shares valued at a minimum of $75 million. And he has to retain 75% of all net shares he receives from equity awards for his entire duration on the operating committee. These provisions ensure the personal wealth of senior leadership is deeply, directly tied to the long-term stock performance, fostering a genuine owner's mentality, thinking like long-term owners, not just short-term managers.
Okay, good alignment there. And when it comes to allocating that immense capital they generate, how disciplined are they? Do they hoard it or put it to work strategically and efficiently?
They operate with a very clear, rational, and consistently communicated capital allocation hierarchy. Another hallmark of excellent stewardship. Their first and highest priority is organic growth. They are, I'd say, fanatically committed to reinvesting capital back into the business to drive future growth. Hiring top talent, expanding branches, developing tech, reinvestment is always paramount.
Growth first. What's next?
Second priority is paying its secure and growing dividend to shareholders. In fact, they increased their dividend twice last year alone, a strong signal of confidence in their ongoing profitability and capital generation. Third, they'll consider opportunistic acquisitions, but only those that are strategically sound and financially accretive, meaning they're expected to add to earnings per share immediately or very quickly. The First Republic acquisition during the regional banking crisis, a perfect recent example of this disciplined M&A approach. Didn't buy it just to be bigger, bought it because it made clear strategic and financial sense, enhanced market position, added value.
Makes sense. Strategic, not just empire building.
Right. And finally, share buybacks are treated as the residual use of capital, employed when excess capital is generated and, crucially, when the stock is trading at a price management deems reasonable, preferably below 2 times tangible book value.
Can you quickly define tangible book value again?
Sure. It's basically the company's assets minus its liabilities, but you exclude intangible assets like brand value or goodwill from past acquisitions. Gives a clearer, more conservative look at its underlying physical worth. This price-sensitive approach to buybacks is critical, ensures they aren't overpaying to retire shares. The evidence strongly supports that capital is allocated rationally, disciplinedly, and in a shareholder-friendly manner. The hierarchy, the focus, the M&A discipline, the buyback sensitivity, all point to prudent stewardship.
Okay, stewardship seems strong. Beyond the philosophy and capital allocation, how does the balance sheet itself hold up? Is it truly a fortress financially? Or is that more of a strategic slogan than a quantitative reality?
Oh, it's definitely not just a slogan. It's a quantitative reality. It underpins their competitive advantage. When we look at the financial metrics, JPM's strength is remarkably clear, consistently demonstrated. First, let's talk profitability and consistency. The firm achieved record revenue for the 6th consecutive year in 2023. Incredible feat. Demonstrates robust ability to grow, take market share even in challenging environments. The diversified business model we discussed acts as a powerful stabilizing force, ensures resilient earnings streams through all phases of the economic cycle. They're built for all weather.
Consistent profitability. What about the key ratios?
Right, looking at key ratios, the story gets even stronger. Return on tangible common equity, ROTCE, arguably the most important profitability metric for a bank, shows how efficiently they generate profits on core equity capital. Remember, ROTCE focuses on tangible equity, stripping out goodwill, other intangibles, gives a clearer, more conservative look at profit generation from fundamental capital. JPM's ROTCE, consistently best in class, regularly exceeding its own target of 17%. They hit an impressive 21% in 2023. That's an elite ability to generate profits on capital. Even during peak COVID uncertainty in 2020, it only dipped to 14% and rebounded quickly. Underscores that resilience.
21% ROTCE. That's very strong.
Extremely strong. And then there's balance sheet strength, primarily measured by the Common Equity Tier 1 CET1 ratio. This is the gold standard for measuring a bank's ability to absorb losses. Indicates its capitalization. JPM's CET1 ratio is exceptionally strong, ended 2023 at an industry-leading 15.0%. This is tangible, quantitative proof of that fortress balance sheet. Represents a massive cushion against unexpected economic shocks, far exceeds regulatory minimums, provides unparalleled flexibility and safety. While traditional free cash flow metrics can be volatile for banks, this strong capital generation and high-quality earnings are what truly matter for financial resilience.
Okay, so we have a wonderful business, incredible moat, strong management, fortress balance sheet. But as savvy learners, we know that a wonderful company isn't always a wonderful investment at any price.
Right.
What's the valuation story here? Does the market recognize this exceptional quality? Is it already priced in?
That's precisely the critical next step. And what's fascinating is that the market absolutely recognizes JPM's quality, and it translates into a premium valuation relative to its large-cap U.S. banking peers. Consistently, JPM has historically traded and continues to trade at a higher multiple. We see this most clearly in its price-to-book ratio, PB, compares stock price to accounting value. As of mid-2025, JPM's PB exceeded 2.4. That's a 92% premium to its level 5 years prior, and remarkably, a 2-decade high.
A 20-year high on price to book.
Exactly. Similarly, its price to earnings, PE ratio, is elevated compared to its 10-year historical average of around 11.6 times. Now, this premium isn't arbitrary. It's awarded for clear, justifiable reasons. Consistent, best-in-class profitability, that ROTCE we talked about, perceived safety, the fortress reputation in crisis, unparalleled business diversification, resilient earnings, and the high credibility, consistent performance of its CEO. In short, the market unequivocally views JPM as the gold standard of banking, and it's quite willing to pay a significant premium for that quality.
Okay, so the market sees the quality and pays up for it, given that premium. Where does that leave us with the margin of safety, that cornerstone of value investing? Is there any discernible room for error in the current price, or is it already priced for perfection?
This is where the rubber truly meets the road for investors, isn't it? The margin of safety principle. You want to buy when the market price is significantly below intrinsic value, a cushion against unforeseen events or miscalculations. For a company of JPM's caliber and market perception, a meaningful margin of safety is unlikely to materialize from something minor, a small earnings miss, a modest slowdown. The market already prices in a very high degree of resilience and exceptional execution for JPM.
So what would it take to get JPM at a price with a real margin of safety?
A genuine opportunity would likely only arise under two very specific, more extreme scenarios, I think. First, a market-wide panic, a severe financial crisis, a deep, widespread recession triggering indiscriminate selling, investors liquidating high-quality assets alongside low-quality ones out of pure, irrational fear. That would truly be an opportunity to buy the best house in the neighborhood when the whole neighborhood's on a fire sale. The second scenario is a company-specific but temporary setback. Might involve a major headline-grabbing event, a very large one-time regulatory fine, maybe a significant trading loss. Something that spooks the market but doesn't permanently impair the franchise's long-term earning power. In such a situation, an investor would need deep conviction to look past the negative headlines, recognize the issue is ultimately absorbable by JPM's massive diversified earnings base.
This truly brings home the idea that price is the final hurdle, doesn't it? Even for what we've established as an absolutely wonderful business.
Precisely.
Yeah.
It's a critical principle to internalize. A wonderful company can absolutely be a terrible investment if an excessive price is paid. JPM serves as a perfect case study. Our analysis confirms it's a truly wonderful company by virtually any measure. However, purchasing it at a 20-year high valuation fundamentally alters the risk-reward proposition. At such an elevated price, the market has already priced in years of continued flawless execution, a relatively benign economic environment. Any significant deviation, economic downturn, unexpected regulation, even a slight miss on growth targets could lead to valuation multiple contraction, resulting in poor or even negative returns for a period, even if the underlying business continues to perform well. The price you pay ultimately dictates your return. A great company is simply not synonymous with a great stock at any price.
Right. Price matters. So as we look to the future, what are the primary engines for JPM's continued growth, and what are the permanent long-term risks that could truly impair this giant beyond just typical market fluctuations?
Let's consider both sides of that coin. The single most important identifiable engine for future earnings growth. It's the deepening of relationships with its existing 82 million plus consumer and small business customers. Since 2019, organic growth has been the largest contributor to revenue growth, By systematically cross-selling higher margin products and services, expanding into wealth management, travel products, more sophisticated payment solutions, to this vast, relatively captive customer base, JPM can organically grow earnings faster than the overall economy, and this comes with minimal incremental customer acquisition costs, an incredibly powerful, efficient growth lever.
Okay, leverage the existing customer base.
Yeah.
Makes sense. Now the risks. What keeps them up at night, potentially? The permanent threats.
Right, permanent impairment risks, beyond typical market cycles. There are three genuine long-term threats I see. First, a systemic financial crisis far more severe than 2008. One that fundamentally breaks trust in the global financial system. Such an event could permanently damage any bank, regardless of individual strength. A potential regulatory response to such an extreme event could also be so punitive. It permanently caps profitability and growth prospects for the entire sector, making long-term value creation incredibly challenging.
A true meltdown scenario.
Yes. Second, geopolitical disintegration. JPM's business model, especially its profitable CIB and AWM franchises, it's predicated on relatively free, smooth-functioning global capital markets, cross-border transactions. A major geopolitical conflict or a rapid, disorderly trend of deglobalization that fractures these markets could permanently impair a significant portion of the firm's earnings power by restricting cross-border capital flows, limiting global reach.
So breakdown of globalization is a real threat.
It is. And third, long-term technological disruption from fintech or big tech. While JPM is currently a tech leader among incumbent banks, a persistent long-term risk is that more agile fintechs or even a large tech firm with immense resources could successfully unbundle the bank, strategically pick off the most profitable capital-light services payments, certain wealth management solutions by offering vastly superior user experiences, potentially leaving JPM with the less profitable, more capital-intensive, highly regulated balance sheet businesses.
The death by 1,000 cuts scenario from nimble competitors.
Potentially, yes. That's the long-term risk there.
Okay, those are significant long-term risks. Are there any catalysts on the horizon that could accelerate value creation for JPM in the next, say, 1 to 5 years, beyond those core growth drivers?
Yes. Looking at the near term, 1 to 5 years, there are two distinct potential catalysts that stand out. Could accelerate value creation faster than current market expectations. First, AI-driven efficiency gains. JPM is investing billions in AI, already deployed its proprietary LLM suite, large language model suite, to over 200,000 employees. A significant near-term catalyst would be realizing quantifiable productivity gains, cost savings in major operational areas, software development, customer service, back-office processing. Management already estimated a potential value of $1 billion to $1.5 billion from its current AI use cases alone. Suggests that as these techs mature, get more broadly integrated, the impact on margin expansion, overall profitability could be substantial.
Right.
Potentially faster than the market anticipates. Could be a significant boost to the bottom line.
So AI paying off tangibly. What's the second catalyst?
Second, the branch expansion maturity. The firm's contrarian strategy, opening over 500 new branches by 2027, is a multi-year investment. It's a quiet but persistent growth driver. As these new branches, particularly in previously untapped markets, mature over the next 5 years, they're expected to gather low-cost core deposits at a rate up to 6 times higher than in their initial years. This significant inflow of cheap funding provides a long-tail catalyst for funding growth, customer acquisition. The full financial benefits aren't yet fully reflected in current earnings. It's a strategic long-game play that should pay increasing dividends over time.
Interesting. The branch bet paying off down the line. Okay, let's apply some second-level thinking here. What's the general market consensus on JPM right now? And then what's a more contrarian perspective that challenges that widely held view? Looking beyond the obvious.
Excellent way to dig deeper. The prevailing market consensus is basically that JPMorgan Chase is the best house in a good neighborhood. Simple as that. Analyst consensus typically falls into moderate buy or buy, reflects widespread acknowledgement of superior execution, diversified model, that fortress balance sheet. However, this overwhelmingly positive view is often tempered by the stock's premium valuation. Most analyst price targets suggest only modest upside from current levels. The market generally believes JPM is top tier, exceptionally well run, but also fairly priced for its quality.
Okay. Best house, fairly priced. What's the contrarian take?
Now for the contrarian view. While our analysis largely concurs with the best-in-class assessment of the business, the contrarian inquiry focuses on a factor the market appears to be underappreciating: the inherent and potentially increasing cyclicality and fat tail risk of the global financial system. The market seems to be valuing JPM as a stable, predictable compounder, almost like a high-quality consumer staple.
Like Procter & Gamble or something.
Right. But this view may underappreciate the fat tail risks that CEO Jamie Dimon himself frequently highlights in his letters. Things like escalating geopolitical tensions, persistent inflation driven by unprecedented government spending, and the unpredictable consequences of quantitative tightening, central banks shrinking their balance sheets, tightening credit conditions. While JPM is undoubtedly the best equipped bank to weather a storm, it is still a bank. And as the saying goes, no ship is unsinkable in a perfect hurricane. The current premium valuation offers very little compensation for this non-zero probability of a severe systemic event, an event that could impact all players, even the strongest, creating significant, albeit unlikely, downside.
So the contrarian view is the market might be too complacent about systemic risks, especially given the high valuation.
That's a fair summary, yes. Underappreciating the inherent risks in the system itself.
Okay, let's synthesize all of this. Can you give us a concise summary of the bull case, the core reasons someone would want to own JPM, and then the counter-thesis, the key arguments against it, so our listeners can clearly see both sides of the coin?
Absolutely. For the bull case, the reasons to own JPM are quite compelling, rooted in our discussion. First, unassailable competitive fortress. We've seen its widening moat. Built on scale brands, switching costs, that Lollapalooza effect, some greater than the parts. Second, exceptional management and capital stewardship. Proven CEO, clear philosophy, rational allocation, strong alignment via insider ownership, compensation. Third, diversified, all-weather business model. Leadership across the banking spectrum provides resilient, through-the-cycle earnings. Internal shock absorber. No single competitor replicates it fully. And fourth, embedded growth optionality, deepening existing customer relationships, leading in tech AI for revenue growth and margin expansion. Significant, durable potential there.
Okay, that's a strong bull case. Now, what about the bear case?
Yeah.
The counter-thesis. What are the key arguments against owning JPM, especially now that investors must seriously consider?
Right, the bear case. Equally important for a balanced perspective. First, the prohibitively high valuation, multi-decade high price to book, offers no discernible margin of safety, highly optimistic assumptions already priced in, little room for error. Second, systemic and macroeconomic risk. As a globally systemic institution, JPM is inextricably exposed to elevated global macro-geopolitical risks. Could lead to severe, unpredictable credit or market losses impacting all large financials. Third, a long-term threat of technological disruption. Fintech, big tech competitors could strategically erode profitability of attractive, capital-light business lines over time with superior niche user experiences. And finally, key person risk. While the firm has a deep bench, strong culture, the eventual departure of CEO Jamie Dimon would represent the loss of a uniquely skilled, highly credible leader. His shoes would be incredibly difficult to fill. Introduces significant uncertainty.
Valuation, systemic risk, tech disruption, and Dimon's eventual departure. Got it. Finally, to really test this, how could buying JPMorgan Chase today turn into a massive long-term mistake for an investor? Let's take on the red team challenge here, invert the bull case.
Okay, the ultimate stress test. The most compelling argument for JPM becoming a massive long-term mistake today, it hinges on violating that foundational principle, demanding a margin of safety. You'd be acquiring the firm at its highest valuation in 20 years, potentially near the peak of a net interest income cycle. Amidst significant global uncertainty, the fortress narrative, while factually supported by its strengths, might inadvertently induce a dangerous sense of complacency in investors, could lead to underestimating black swan events, like a sophisticated systemic cyber attack, a risk which JPM's own internal red team actively prepares for, constantly trying to breach its own systems to find vulnerabilities.
Even the fortress prepares for breaches.
Exactly. Suggests even they acknowledge vulnerabilities to unforeseen high-impact events. The fundamental error would be paying a premium price for a business whose earnings are, at their core, cyclical and leveraged. A severe, unexpected economic downturn combined with a violent contraction in the valuation multiple awarded by the market could trigger a dual shock. This combination could lead to a significant, potentially permanent loss of capital, could take many, many years to recover. In essence, the mistake would be buying a wonderful company at a price that leaves no room for error, in an industry where unforeseen crises and human error are not just possible, but inevitable.
Wow, what an incredible deep dive into JPM. It truly highlights that even for the most dominant players, the story is never just one-dimensional. Understanding the nuances, the risks, the price, it's all paramount.
Indeed, it really is. And as you reflect on JPM's incredible strengths and its vulnerabilities, consider this. If even the fortress of the financial world acknowledges and actively plans for black swan events like a systemic cyber attack, what does that truly tell us about the inherent, inescapable nature of risk in the global financial system? And what does that imply for how we should approach all our investments, even those perceived as the safest?
A powerful thought to leave you with. We hope this deep dive has given you some truly valuable insights and helped you connect the dots in new ways. Thank you for joining us on the deep dive.